Greetings, everyone. I'm David Darst, here to give you a brief recap of the month of October. Obviously, a lot going on prior to the national elections in the United States. The S&P 500 was up 0.8% as the month neared the end. NASDAQ up 1.8%. Russell 2000, which is small and mid-cap stocks, that was down 1%. Gold was up 4% as the month neared its end, and oil was up 5.3%. There's reasons for that, and we'll get into them in a moment. Turning to the Treasury market, the 2-year Treasury, the 10-year Treasury, and the 30-year Treasury all had significant rises in yields. Number one, the 2-year closed at 4.11%, where it was up 45 basis points over the month of October. The 10-year closed at 4.28, and there you're getting that positive yield curve of 4.28 for the 10-year, 4.11 for the 2-year, so it's a 17 basis points positive slope now. It was up 44 basis points, and the 30-year Treasury closed at 4.51, and that meant it was up 37 basis points on the month. I would be remiss if I ignored or omitted mention of Tesla. On the 26th of October, Thursday, that stock rose 21.9% in one day. A lot of Tesla fans were cheering that performance related to better than expected sales numbers and, very importantly, better than expected margin numbers and a reasonably positive outlook by management. The market capitalization of Tesla today is $844 billion, which makes it the largest market cap stock in the automotive industry in the world. Second is, of course, Toyota. That's $246 billion, something like that. BYD is $180 billion. Ferrari is $80 billion. Porsche is $70 billion, and Mercedes-Benz is $67 billion. So there you see the tremendous valuation that investors are putting on Tesla. We don't make specific calls on specific stocks, but that certainly has got a lot of positive things built into that price and expectations. The month of October, of course, the jobs numbers were very strong for September. September's jobs were 254,000. That's one of the reasons interest rates were up. The August numbers and the July numbers combined were revised upward by 72,000. Unemployment was 4.05%, down from 4.3% in the month of July. So there you have 4.3, and if you round it off to one decimal place, that's 4.1%. The East Coast ports, 36 ports on the East Coast of the United States, had called for a strike. That strike was averted. It's not over. It's been postponed to January while they discuss the retirement part of this, healthcare part of this, and other terms. But for a moment, they have gone back to work, and we will be following that and keeping you updated. The trailing 12 months price-earnings ratio of the S&P 500 here at the end of October is 26 times earnings, which is 50% more than the long-term median S&P 500 price-earnings ratio for trailing 12 months earnings, which is 17.1. You have for it to go higher, it seems to be at a very elevated level in our opinion, and if that's in the 90th percentile over the past 80 or 90 years, so it's up there, the price-earnings ratio. The Bank of Canada, during the month, they lowered their policy interest rates by 50 basis points to 3.75%, and they indicated in their notes and minutes and commentary that they're likely And the Fed funds futures markets for Canada now are expecting another 37 to 40 basis points cut between now, early November, and the end of the year. The Chicago Mercantile Exchange for the United States, Fed fund futures markets there are currently pricing in a 95% chance of a 25 basis point cut here at the beginning of November, just after the election. The Fed will meet on the 6th and 7th of the month of November, and 95% chance of a 25 basis point cut, and a 5% chance of a zero, no change. Now, the reason is the economy has been reasonably solid and resilient. That's why you're getting this pricing of Fed fund futures of 25 basis points. And then we have another one at the December 17th, 18th meeting. That's an open question depending on the data. The Fed has said this over and over. First quarter GDP growth was 1.6%. Second quarter was 3.0%. And here the Atlanta Fed's GDP Now forecasting tool is looking at, here at the end of October, at 3.3% for the third quarter. So you have this resilience. Retail sales, I think, were one of the reasons. Significant rate cuts by the Fed. Why? Retail sales for the month of September were up 0.4%. That's one of the better months this year. That compares to August, 0.1%. You're going to get reactions to the late in the month of October. You had earnings results from the Big Five. You had Apple, you had Amazon, you had Google, you had Meta, and you had Microsoft. If you look at the Taiwan Semiconductor, had very, very good results during the month that they announced, and they offset the disappointing results of ASML, which is the big extreme lithography machine manufacturer in Eindhoven, the Netherlands. So you've got conflicting and cross currents going on in certain parts of the technology space, and that's been one of the big lifts to the stock market being up as strongly as it is. From an asset allocation standpoint, we favor credit over equity. There'd be some liquid credit. There would be some collateralized loan obligations, maybe some high yield fixed income securities at the high end of the quality spectrum. Leveraged loans would be another one that we would encompass right now in our asset allocation. The 60-40, the traditional 60% equities, 40% bonds. We think that model is old-fashioned, and it needs to be tweaked and adjusted to encompass a significant allocation to alternative investments, pick up better yield, reduce portfolio volatility, and enhance the risk-reward, risk-return profile of portfolios and of asset allocations. In private credit, we seek seniority in the capital structure and good protection via covenants. In private equity, we continue to focus on secondary market interest. You're seeing more and more secondary market interest sold by general partners needing to raise cash, and limited partners also needing some degree of cash. With that, we wish everyone a great start to the month of November and look forward to catching up with you very soon.